if you have $1,000 to spare, how would you use it or how would you invest it?
A lot of people think $1,000 is not enough, but it's not true. $1,000 is absolutely enough.
Alright, so we are back with our So Far So Good Season 2, and this time around, this is episode number 4, so stay tuned with us because we have Timothy Ho in the house, and Timothy Ho is the co-founder and managing editor of Dollars and Cents, which I think a lot of you guys have already read some of his articles on his editorial because they talk about a wide range of topics, all the way from investing at the young adult age towards your working life, towards building a family. They also talk about real estate stuff, which we are very interested to have Timothy share a little bit more with us this time around. Check out their new YouTube channel because they have a couple of very interesting content as well on their YouTube channel. So Timothy, good to have you with us.
Thanks, Melvin. I'm glad to be here because I watch your videos all the time.
Today we want to chat a little bit more about young adults investing, some of the key mindsets when it comes to investing at an early age all the way to the adult age. And later we look forward to chatting also a little bit about the property market as well. So I think for the sake of our audience, maybe give us an introduction about how did Dollar and Cents got started.
So Dollars and Cents is a personal finance website that me and my co-founder, we had this idea back in uni actually, and we actually started the website in 2012 right after we graduated from university. For the first 3 years, it was actually a passion project. So me and my co-founder Dinesh, we had full-time jobs, and then we were just doing Dollars and Cents as a project, as a sideline, writing articles over the weekend. And then sometime in 2015, we thought like, hey, this is going somewhere. Maybe it can actually not just be a passion project, but also a full-time job. Wow. So I actually left my previous job to join Dollars and Cents full-time in 2015. So I've been working about 6 years since. Besides running Dollars and Cents, I'm also a dad. I totally can see and empathize with the adulting age, where you go from being a fresh grad, just starting to join the workforce, to buying your first property, and then subsequently having kids. And recently, we're moving houses again. So I'm also in that stage again where, you're starting to think about renovation and thinking about your future when it comes to where your kids are going to live in and things like that.
Right. So in 2012, you were still schooling with your co-founder?
Yeah, I just graduated.
Okay.
2012.
And you guys call it a passion project because it's really like out of interest that you wrote articles for 3 years.
Yeah, it has to be because for the first 3 years we were not making any money, obviously, because we were not really doing out for money. But then I think, and that's one thing I always think about entrepreneurship people should do, right? So if you have an idea that you really are passionate about, you don't have to quit your day job yet, because in Singapore you still need to have a salary, you still need to work, right? You can pursue it as a side hustle, as a passion project. And then, give it 1, 2, 3 years. And once you realize that, hey, this is something I really want to do, and I'm going to continue doing it even though I'm not even working at it full time, then that's where you know that you might be onto something.
So share with us what was your day job before you finally embarked full time into Dollars and Cents in 2015?
So before I joined Dollars and Cents full time, I was actually working as a corporate development executive with one of the listed companies in construction. So I also a lot of construction related stuff, and I help them with your proposals, your corporate comm, investor relations matter. So a little bit of that whole finance things where you are communicating with people on the company's performance and things like that, but also somewhat touching base a little bit on property related matters as well.
Right, which give you, I think perhaps the inspiration on your editorial, because I think the topics that you covered and is currently covering as well, it is a very interesting kind of format because you talk about CPF, you talk about investment, talk about insurance, and I think there's a lot of tips and guides as well. So what is the main focus of Dollars and Cents?
Good question. So I always tell people that for Dollars and Cents, the way we look at finance is from a consumer point of view. Right, so what do you need to know as an average person living in Singapore when it comes to financial related matters? So that's the reason why we have all sorts of topics. We have things like your lifestyle topics, we have things like how to invest your money, insurance matters you have to decide on, buying a property, obviously a big topic in Singapore always, and of course your government related policies like our CPF scheme and Singapore budget and things like that. So it's always from a hyper-local, consumer-centric point of view, where what are the financial decisions we have to make as we go through life, especially as a working adult. So a large part of our target audience is actually your working adult age, all the way from say 24, 25 to in your 50s or even your 60s, because this is the stage in life where we end up making the most number of financial decisions for ourselves and our families as well.
Right. Okay, great. Thanks for sharing with us about dollars and cents. And I think your editorial is going very strong. And just now we chatted a little bit about your team, and I think you have a very matured team. And based on the reading that I saw some of the articles, I think I also learned a bit of things here and there as well. So I want to prick your brains on the property market for 2021. What do you think of the property market now?
Well, property has always been a passion for me since uni, before I started Dollars and Cents. And I think, we've seen the cycle, right? So I still remember how in 2010, right after the global financial crisis, you see property prices at that point in time was low, but you keep seeing a lot of new launches, prices going up. And I think cooling measures started coming in, but even then, it still continued to perform rather strongly. And for some reason, it feels like that's happening again, right? So you have the COVID-19 recession, the pandemic and a recession last year. And then to a lot of people's surprise, the Singapore's property market did not go through a slump. It started, it remained strong, and then it started going up again. And nowadays, you're seeing a lot of new launches also as well. So I would say that, the property market right now is quite exciting. A lot of people are trying to get into it. Most of us are getting it because, we need a home, or we need a bigger home. So there is a genuine need for space or more space. So I think that adds to it. Interest rates are definitely very attractive right now. So I think, you can get an interest rate for 1%, 1.2% quite easily, and that obviously is attractive. So I think it's interesting. I'm not too sure, what's the upside. I'm not going to speculate about it because I'm not a property expert. But, for people who really want to buy a home and they have seen a home that they like, I can see why they will go for it if the price is right.
So as a Singaporean, based on your work, definitely you are in tune with the market in terms of finances, where the economy is going and things like that. Do you think that based on a young person, somebody that just graduated from uni, and what will be usually the route to investing while working towards their first property? We chat about a single person's perspective.
Okay.
Yeah, so because as a couple, government is very pro marriage, right? So naturally, a lot of young couples, they can get BTOs and resale at a fairly young age, below 30. But let's say for a single person, because we had this episode on our Nuggets on the Go, we chatted about the length of time before a single person can actually start to own their first property. So what do you think from 25 to 35, the in-between route, usually based on your research and experience, what are some of the things that a young person can invest into, like stocks, bonds, ETF, and things like that?
Yeah, good question. So I think for someone who is single, and unfortunately, or depending on how you look at it, unfortunately, whether you talk about a couple who is intending to get married and a single, is quite different in Singapore, right? I think for singles, one of the main things that they want to do as early as possible is really to start investing, because compound interest can work in your favor when you are young, right? So when you start investing, you give your chance a few advantages you have, right? The first is you start learning about investing young. So you might make mistakes. You probably will make mistakes, but you have enough time to recover from it, especially because when you're young, the chances of you investing, you probably invest a smaller amount because you don't have that much money yet. So I think that's one advantage you can make, which is you can afford to make mistakes when you're young. But when you start investing early, you also enjoy compound interest. And then we like this concept called dollars cost averaging. What it means is that, let's say you make $3,000 a month, your take home is $2,400, and you set aside maybe 20% of that, $400-500 each month to just invest into the financial markets. This could be in ETFs. I think I would typically advocate for people to invest in ETF, whether it's a Singapore-based ETF or a US-based ETF. That's a good way to get started. You would see, you would maybe make losses sometimes, but the whole idea of dollar cost averaging is that you just average in. So when the market goes down, you actually invest the same amount and you get more units. And when the market goes up, you invest the same amount, you get less shares, but you're accumulating. And ETF is a good way to start accumulating wealth, right? Because you're getting good companies that are in a good position to not just give you returns today, but also give you returns over the next 10, 20, 30 years, which is what we are interested in. I think for a lot of people these days, after they invest in ETF, if they want a hands-off point of view, they can start with Robo-Advisors. So I think in Singapore right now, there's a lot of choices when it comes to Robo-Advisors. You've got your StashAway, your Endowers, your Scythe, your Auto Wealth, right? So there's a lot of these money hours. So there's a lot of these platforms that can allow you to invest from some of it from as little as $100, but some of it even lesser than $100 you can invest already. And I think the whole idea with investing a small amount, not necessarily is to make a lot of profits at the start, but it's to instill the discipline of investing regularly. And number two, to get a sense of how is it like to invest, how is it like to buy a stock, or to at least make a transaction through a robo-advisory platform. And I think this you know, we are at the age right now where we see some of our single friends are thinking about buying their own property already.
Yep.
And what I realize is that a lot of these individuals, when they start investing from a young age, when they reach the age of 35, you know, they have more wealth. They have more wealth which can actually help them with, say, getting a flat, a resale flat when it comes to
towards their down payment.
Down payment at least, right?
Right.
And that's something, and of course you don't forget they got CPF as well. So when you have your CPF combined with your investment portfolio that you've been investing since 24, 25, you know, that adds up to a lot. And what I realized is that for a lot of them, they don't even need to use all their CPF money to make the down payment, or they don't have to liquidate all their investments. They can use a combination of both, and that can give them a pretty good house that they want, actually.
Right. Coming back to just now, you were mentioning about robo-advisors and all that. Do you see like an uptrend ever since the circuit breaker? Like, do you see that? Why do you think there's this phenomenon?
I think the whole idea about markets is that typically, whether it's long-term investing or trading, people get excited when there's volatility, right? So when prices goes down, everyone gets excited. Hey, you can invest in something that is 20%, 30% lower than it was last year, right? Or last month, sorry. When prices goes up, people also get excited, like what we're seeing with the crypto space right now, right? Where there's a bull run over the last 18 months, and a lot of people are getting into the market because there's a little bit of that fear of missing out, FOMO, right? So I think that has also we have also seen that kind of interest when it comes not just in stocks, but in like trading, like forex trading, CFDs, or even things like your robo-advisors, where people are just more keen to invest because they recognize that, hey, I can see the market going up, and I realize that if I invest, I can see my money increase each month as the market goes up. So that typically gets people excited. But of course, there is always a word of caution here, right? Markets goes in cycles. So what goes up can go down. And so I always tell people that you need to be able to stomach that investment that you're making, right? You need to be able to be confident to say that even if the market goes down, I won't get so worried. Because what I've also seen is people investing a large sum of money into, say, a specific stock. This is in the past. And then when the stock tanked, their money is stuck in there, they lost a few $1,000s, and then they tell themselves, hey, you know what, I'm never going to invest. Investing is dangerous. And that's also not the outcome we want people to have, because once they have a very bad first experience investing in, say, you just have to invest in a stock for, say, $5,000, and then it goes down to $2,000 after a year, and it just turns you off investing, which is not good in the long term, because losses are part of the game here when it comes to investing. But then you don't want that first experience to really set someone back such that they are not even open to investing more in the future. Yeah,
and I think the important thing is that the mindset of investing, it should be a mid to long term kind of mindset, and not like a mindset that you want to make a quick buck. Because I think the moment you have that mindset, the moment you see that in terms of its index dropping, and you start to see that paper loss, you start to become fearful and you want to exit, you realize that loss. So I think like what you mentioned, dollar cost averaging is important. Starting to invest at a young age is important. We also chatted about using the CPF and cash component, right? So this is a very common question. I mean, we talk about that a lot in our educational series as well, on the pros and cons. And to me, I feel that this is a chicken and egg thing as well. But the most important concept is that, do you need the CPF to accelerate your speed to pay for the down payment? Because that is sort of like a forced saving that our government has pre-planned for us, which made Singapore a nation with such a high ownership rate, more than 90%. But I think if the government didn't implement CPF, a lot of people will not be able to afford their home, because this is something that we cannot see, which is a great benefit for us. I mean, human beings, when you see extra cash in your bank, you definitely find a way to spend it naturally for most people. So I think the CPF is sort of like a forced saving kind of thing. But the question comes back with the fact that CPF amount is earning you 2.6%. 2.5% in your OA account, and of course the first tier, it earns a little bit more, close to about 4%. So what is your preference? If somebody has the capability to pay off a down payment for maybe a $1 million property, plus stamp duty, which is about $274,000, using cash, and they also have a substantial amount of about 200,000 in their CPF. If you have the choice, I mean, will you just fully use cash, or you will use partial, or what will you do?
Oh, that's such a deep question with so many different answers, right? The truth is, look, I'm gonna get the easy way out here and say it really depends. But let me explain a little bit more, right? So I think a lot of us, what I see is that people tend to lean on extremes, right? So you have a lot of people who believe in just maxing out the whatever they can use from their CPF OA each month, right? So they buy maybe the most expensive property that they can afford, and then they maybe stretch the loan also, and then they use their CPF OA, they max it out as well to afford the property. So I think that is, in some sense, it's good because, you get a house that you need to live in anyway, and you get to enjoy living in that property without actually coming out with any cash outlay because you're using your CPF. But the problem is that in Singapore, I don't think we can disconnect our property purchasing decisions from our retirement, right? So the more you use from your CPF today, it means the less you have for your retirement 10, 20, 30 years down the road. And I think that's one of the trade-offs people have to consider, because you're not only using your CPF money, you're also losing that opportunity to compound that interest at least 2.5%. If you some people choose to top it up to their special account, so that gives them 4%. So that's actually quite a lot of it actually compounds to quite a fair bit of money, right? So I think that's one extreme where people use all their OA to do so. The other extreme, of course, is that you don't necessarily, let's say I have $1 million right now, I'm buying a $1 million condo. I don't think I'm going to pay $1 million down just for it, so that I don't touch my CPF. I will probably take a loan as well, because interest rates are really low right now.
Yes.
So with most rates, even at fixed rates, you can get 1.2, 1.3% per annum. So if you think about it, you're paying 1.2, 1.3% to the bank, but then the CPF OA is already giving you 2.5%. So that's already a win on its own, and it's kind of like risky for your CPF money, right?
Yep.
So I think I wouldn't pay down as well, because I think having cash on hand, or even having money in your CPF, is able to generate you a return that is higher than the interest rate we currently pay, right? But does that mean that we should borrow the most we can borrow? Not necessarily also, right? So some of times we also feel like, especially when you are near retirement age, you don't really want to have loans, even though you might be able to service them. So I think it really depends on the personal preference. But I would say, if I have $1 million and I'm buying a $1 million property, I'm not going to pay $1 million. I'm not going to pay it
definitely
down. Leverage. Keep some money in your CPF.
Right. And I think it also boils down to the fact whether the cash that you have on hand, if let's say we are just talking about down payment, 274,000, because the minimum you need to put in is 5% cash, 20% CPF, followed by your buyer's stamp duty. I think it's also about how much can you generate in terms of returns using your cash in the stock market, in the bonds market, ETF, and things like that, compared to the CPF component that you can earn 2.5%. So as long as your cash can outperform 2.5%, then definitely it makes sense to use your CPF and then keep your cash outside for alternative investment.
I think one thing people need to note is also that you need to have cash buffer in order to set it aside for emergency saving for your house, right? So for example, if let's say I buy a $1 million property today, and assuming I have $500,000, it's not in my interest actually to just pay down $500,000 and take a $500,000 loan, because what happens if I lose my job 3 months from now, and now I don't have the money to service the $500,000 loan? I would have been better off maybe say paying down $250,000, the minimum required, keeping $250,000 in my savings account, or maybe even in my CPF account, because you can still use your CPF OA to pay for your house. And then if I lose my job 3 months from now, at least I have to service my $750,000 loan, which is higher, but I still have my $250,000 in cash or CPF, which helps me to pay for my house probably in the next 5 to 10 years still, without having to worry.
Right.
So I think we need to make that's a decision that I think people need to realize also. Paying as much as you can for your home isn't necessarily a good financial decision, because if you don't have enough emergency saving, what that means is that you actually don't have that buffer in the event that something like you lose your job or you can't work for a few years.
Right.
You are forced into a position where you might need to sell your house.
Right. Yeah, I think that's extremely important. The buffer in terms of life changes and all that. Just to digress a little bit, so Timothy, what has been some of the hottest so-called readership in terms of viewership and readership for your articles this year, like in 2021?
So one of the trends we're seeing is property and CPF, right? Everyone, a lot of the property and CPF related article that we write about these days, people are reading about it, right? So it can be as simple as a BTO launch guide, where are the locations, people are reading about it, how to apply, what are the grants, it's caught me a bit off guard, but at the same time, I'm not surprised because we are all at home, we all realize that we're working from home, and the first thing you think about is, can I make my home better?
Yeah.
Do I need a bigger, if I'm staying with my parents, do I want to buy my own place? Do I want to rent my own place?
Yeah.
If I'm staying with my kids, should we get a bigger house? Do we need a study room, right? So these are clearly the most important decisions that I think a lot of us Singaporeans have been thinking about over the past 1 year, which is, where are we living and is it conducive and suitable for us?
Yeah, and I think this is like a human innate behavior, because ever since the introduction of circuit breaker, everybody sort of like just zoom in their focus to a few key things. Now we mostly eat at home, we work at home, our kids home-based learn at home, and then even church is at home, plus you exercise at home. So I think the key focus through the past 18 months ever since circuit breaker is like our friends in the renovation ID space are saying that their amount of so-called like demand for renovation while the family is still living within a home has increased so much. People are renovating, upgrading their carpentry and things like that while they're still living there. And then secondly is, of course, even ourselves, when we look at things on the ground, a lot of customers that we're serving, they are switching units within the same project. Yeah, getting us to sell their 3-bedder, move on to a 4-bedder, just to have that extra
Size,
space.
right.
Yeah, so cars has increased in pricing as well. Do you do articles on cars?
We do articles on cars.
What do you think? Where do you think this thing is going? Because seriously, when we look at cars, like when I started out in real estate, that's like 15 years back. Then when we talk about like a Continental car, right? You can get something in the range of about 100 over 1,000, 130, 140, 150,000 Continental entry level. Now it's as if like every entry level Continental car is like 250 onwards, 300,000 onwards. So where do you think things are going? And in our perspective, actually we advocate this a lot to the hot money that is flowing in because of quantitative easing. Yeah, and this is flowing into tech stocks, into the stock market, into crypto. And then of course, when people realize gains, they want to park their gains into a physical thing, right? And people are parking them into gold, parking them into real estate. They are buying cars, and there's also a lot of FOMO involved. So although we look at the consumer price index, inflation is less than 2%, but in actual fact for asset inflation, it has went up so much over the past 18 months. Just maybe back to the topic of car, where do you think this is going?
Yeah, I'm a car lover, but I'm not an expert in cars, so I'm not going to say which car is better or what. I think the issue with, like what you say is right? Asset prices have increased. People are actually, people who invest, they're actually making money from their investments. And some of them, because they can't travel, especially in Singapore, they are putting their money into things which they can also enjoy, right? So cars are obviously one of the things that, you can enjoy, because you're staying at home, maybe you can drive your kids out more often after your work from home, and people are actually buying these things because they're starting to realize that, hey, I'm not traveling, I got the extra cash, I want to enjoy cars. I can give you an example, right? One of my cousins actually shared with me his experience about yacht. So he was looking at some yacht in Singapore, and this was before COVID. And he was telling me that it's always been a dream of his to try live on a yacht, which it's not as expensive as what people think, because you can actually buy a second-hand yacht for a 5-figure digit. Actually, so it's not new, but it's livable. It's probably as big as a 3-room HDB flat. So if you're just living by yourself, that's still okay. And then you of course you have to dock it.
The docking fees and all that.
But the docking fee, it's not incredibly high. So maybe 1,000, 1,500 a month, which is still acceptable, because if you think about it, if you rent somewhere else, you probably have to pay that as well, right? And he was sharing with me that yacht prices in Singapore has increased tremendously over the past 18 months. So it's not just cars or that are getting more expensive. Not just properties that are getting more expensive, not just cars. It's even things like yacht. And even now, even if you want to, assuming you have the money, it's not easy to find a yacht even, because there's no supply right now. It's very difficult to
People are
find.
not letting go of their yacht.
People are not letting go. People are not creating, and they are being snapped up anyway, right? It's because yacht is one of the ways that you can still travel overseas, right? You know, right now, if you're a Singapore family and you have a bit of money to enjoy,
Right.
So
That's
I think
interesting. Right.
So I think asset prices are going up. I think with regards to cars, I do think that, you know, the Singapore government will continue to want to taper down in terms of the amount of COE, the supply.
Yeah, I mean the Cat B just surpassed 70,000, and
they're reducing the COE
right.
quotas, right? Because they say that there's no growth in COEs, and I think, you know, we want to go to a car-like nation. I think a lot of the if you look at a lot of the CBD launches, the condo developments, they don't even have parking lots for every unit anymore, and I think that kind of makes sense because often you don't use all the parking lots anyway, right? Yeah. So I think in general, you know, you will see less cars, but cars will be more expensive in Singapore.
Right. And when I was looking at how things are going for the past 18 months, I mean, not just in Singapore, but also in globally as well, I think one very concerning thing is definitely the wealth gap. Yeah. So the wealth gap is definitely widening because when asset prices increase, people who owns asset, they become richer. Right, and I think the middle class portion is also being stretched, right? So, I mean, of course, thankfully we're in Singapore, right? We, if you work hard, you can go for BTO, you can go for resale. There is the housing at the middle level that is available for everybody, and of course you have grants and resale grants and things like that. But what do you think, like in 5 to 10 years time, based on your own research, right? And you just upgraded your home as well, so congratulations. Where do you think private property prices will go, like in the next 5 to 10 years time?
I wouldn't want to speculate too much, but I absolutely agree with what you said, which is like that feels like there's a wealth gap between people who own assets and these asset prices are going up versus people who don't, right? I think in Singapore, largely speaking, most of us are quite fortunate in the sense that we own our own homes. I think home ownership in Singapore is 90% or more than 90%, which is one of the highest in the world, right? But what I do see is that fear among, you know, I have friends who are single, and I think some of them, there is that fear that property prices are actually
getting
moving
out of reach, right?
Ahead too fast compared to their income, for example, right? So even when you talk about a resale flat or private condo, you know, it's gonna, even a 2-beders, you know, new launch,
1.2
be
million.
like 1 mil or more, right? Which is very difficult to afford if you are single and just on single income, right? Even HDB resale flats are not cheap also. You know, even though there are still, you know, opportunities if you can
grants and all that.
Grants, or I think maybe if you don't mind older flat that has a shorter lease, you know, there's still opportunities, but by and large, you know, they are not cheap either. So I do feel that's one concern that people have right now, a legitimate concern, I feel. And I would say that, you know, in Singapore, if you were to ask me, I think, you know, it's always, to me, it's risky not to own your own home because you don't want to constantly perpetually be in a rental market where, you know, you see asset prices climbing, and then you have to pay maybe higher rents each time you renew. So I think Singaporeans want to own their own home, whether or not like property would be the greatest investment in Singapore, right? Where, you know, you should just put all your money into property because you think that, you know, it will give you that 5-10% per annum growth. I don't think so. Personally, I don't think so. I think there's a lot of opportunities as well when it comes to investing outside of property. You know, you can invest in US companies, tech stocks, robos, even places like China, for example. So I think there's a lot of investment opportunities, some of which will give you maybe even higher returns. Of course, higher risk also, maybe. But I think when it comes to at least owning your own property and maybe even one investment property, I think that's something that, you know, isn't necessarily a bad idea if we're living in Singapore. Yeah,
because I mean, Singapore is so land scarce. Population is still growing steadily every year, and our government when they plan something, URA, they execute it. So
they have a good track record. Our government has a good track record of developing places that they want to develop. So Tengah, for example.
Yes, yes. And we always share with our audience not to time the market, because the moment you time your market, especially for a primary residence, is a very risky move. Yeah, and for the past like 15 years, those who really time the market, usually they are priced out of the market, because although we are looking at the price index on a very gradual growth basis because of the cooling measures, but on the ground, the actual fact is that the quantum prices are increasing. Just for example, in the past 2 years, you can still get a 2-bedder new launch for below $1 million. But today, as we speak, there's nothing that's below $1 million for 2-bedders. In fact, the only thing that's closest to $1 million are 1-bedders that are about 900,000. So this is actually quite an interesting phenomenon, because the price bracket is increasing almost like every year. And right now, what is happening on the ground is that the developers are starting to clear their balance inventory. We just did like a training yesterday to our guys on the 4 different types of movement across every 5 years. It's like now all the balanced new launches are being cleared off very quickly off the shelves. Next phase, what might likely happen is that developers, once they clear off their inventory, they are heading on towards completing their current projects. They will definitely want to bid for more land from GRS, start maybe another en-bloc cycle, and then we'll start another new cycle of new PSF pricing for new launches, which I think this route seems a bit too fast, because everybody thought that, after COVID, prices will sort of remain stable, or it might maybe have a little bit more slower growth rate, but in fact the reverse happened. So I think it really took everybody by surprise, right? So which I think gave rise to people wanting to invest, because they want to have a hedge against their current savings and all that. Do you advocate just saving purely without investing?
No, that's not feasible in Singapore anymore, because with inflation, your bank interest rate right now is terribly low, as all of us know, because even our loan mortgages have low interest rates. So just imagine how little the bank gives you for putting your money in there, right? So I think one of the challenge that people have right now is that money in the bank doesn't really earn you any return, and you cannot possibly build wealth just saving, right? But at the same time, asset prices feels like they are very expensive, right? So whether you buy a stock, property, or even bonds are giving very low returns as well, right? So I think that's the dilemma. Gold prices, cryptos, everything just seems expensive right now, right? And that's also largely because of excess liquidity in the market. So I think that poses a challenge for a lot of us as investors. We're trying to think what we should do. And my advice would be to go for assets that when you want to go for assets that are strong. You want to invest in strong companies. You want to invest in assets that are shown to be resilient enough, such that you can hedge. I think property is a good way to actually hedge wealth, right? Because if you think about it, property prices typically reflect the economy that we are in, right? And as the Singapore economy continues to remain strong, you can expect property prices in Singapore to remain strong. So that's a good way to hedge wealth. But of course, you can also grow your wealth in other areas as well, through your stock investments, through your robo-advisory platforms, or even for people who don't know what to do with their their savings, they can actually consider topping up their CPF account, because the government does give you that risk-free interest rate of at least 2.5% in the ordinary account and then 4% in the special account. So one of the things I think some people are doing, I can't remember the stats, but I think CPF do have the stats, which is they notice that more people are actually doing I think they call it the HDB voluntary refund scheme. I'm not sure if I got that pronunciation, the scheme correctly, but what it basically means is that if you have used your CPF money to actually pay down for your HDB loan or your private property, you actually have that amount which you took out from your CPF. You can actually top up that amount back at any time you want. Right? So in that sense, that's not too bad, because by putting it in there, you put your savings get extra 2.5% per annum. The trade-off is, of course, you can't use it to buy your cars later on, right?
Correct.
But you can still use it to pay for your house. So in some sense, that's not too bad if you want to earn a bit more interest on your savings that's going to be idle in your bank. But at the same time, knowing that if you need to, you can still use the money to pay for your home later on as well.
Right. All right, so one question. I think this is probably one of the most useful questions for our young viewers. So if you have $1,000 to spare, how would you use it or how would you invest it?
Good question. So a lot of people think $1,000 is not enough, but it's not true. $1,000 is absolutely enough. What I would do with the money is that I would try to invest it on my own. So the whole idea about investing on your own is, it's like, you want to learn swimming. You can't just watch YouTube channel on how to swim. You must go into the swimming pool to try swim, right? $1,000 gives you that amount to go into the swimming pool, right? So you can try investing in, I would say, try investing in US companies, right? ETFs, companies tech companies, for example. Try investing in Chinese company. I think that's also interesting, because you need to be able to understand how you can navigate, purchasing stocks from overseas, as well as, of course, start investing in Singapore as well.
Right.
Commission charges right now are not so high, right? In the past, you used to buy like $20, $30 if you want to buy a stock. Right, nowadays it's like $2, $1. So you can actually, with $1,000, I think you can actually easily buy 2 to 3 counters. So it could be ETFs or companies, and that's what I would do because it helps jumpstart your financial literacy journey. You start to learn how to invest on your own. You start to see the chart moving, see what it means to lose money, and I think that's an education that is worth spending on.
Right. What do you think will be a good percentage for a young person? Let's say they cannot afford a down payment for a property yet. What should be the allocation of the percentage of their monthly income towards investing, towards savings, and then towards spending?
There are rule of thumbs, right? But what I would do is maybe I share some of my own experiences, right? So when I was, and this was back when I just started working, not at dollars and cents, but my first job. I think my wife and I, we save about 30 to 40% maybe of our take-home salary each month. 40% of our take-home salary. Obviously, at that point in time, we had BTO flat, so we knew that we wanted to save for our renovation as well. But at the same time, we were very diligent in saving. And then, of course, investing a small part of it. I invest a small part of it, but we also had to save up because we have our renovation, our wedding coming up. So I think, as you are younger and you have less family commitment, you have kids yet, or maybe, your parents still don't need your financial support, saving about 40 to 50% of your take-home salary is very doable. And I have actually friends who save much more than that. So that's quite impressive. I think when you tend to become older and you have kids, trying to save that amount becomes a lot harder, even though your salary might have grown, right? So if you just started working right now, my advice would be, keep to your university lifestyle habits, right? So, you might, in uni, you'll probably spend maybe 500 to 700 or 800 a month on food, transport and stuff. You can maybe spend a bit more, but try to keep to your university lifestyle habits as far as possible, because lifestyle inflation is what's going to cost you in the long term. And then take the remaining amount of, like, say 50% of your salary. So if, let's say, you make 3,000, your take home is 2.4, you can spend 1,200 on whatever you like in life, and then you save up and invest 1,200. I think that's a great start.
Right.
And if you don't have a house, you can actually, unlike me, you can actually invest more aggressively, right? You don't have to save up because you don't have like a wedding coming up in 3 years' time. So you can actually invest more, and that actually will give you a greater a head start compared to your peers who might be having to save up for their own home or their own wedding, and they can't invest.
Right.
And that early day investment would compound more in the long term as well.
Last question. Share with us 1 to 2 books that you recommend to young adults to read on financial literacy.
Okay. I would share one of the books that I read when I was in uni. I think it's called The Undercover Economist by Tim Hartford, if I'm not wrong. It's one of the few books that, I really enjoyed it. It's not a very popular book, but I really enjoyed it because of how the author actually wrote about how economic decisions around us that happens affect us on a daily basis all the time, right? And so there's a lot of very interesting insights that he shared, and I would totally recommend you guys to read that. The other book I really like to read, ironically, is called Dollars and Cents. Can't remember the author name, but it's it's a very interesting book as well, because he explains how people make rational or non-rational decisions all the time when it comes to the financial matters. So that's a 2 book I will recommend.
Awesome, great, thanks for your time, Timothy, and it's been great chatting with you. And I think we talk about a wide array of topics, and also about sharing your personal sort of journey in your property portfolio space and planning for your future as well. So this is Timothy Ho, managing editor of Dollars and Cents as well as co-founder, and do check out his editorial. The links are below, and of course I think what we can do is that, Timothy, you can send us some of the very hot and popular topics. We can just attach down the description below for our audience to read out a little bit more. Thanks for your time.
Thanks, Melvin. Thanks so much.
Great. All right, see you guys.
So if you have an idea that you really are passionate about, you don't have to quit your day job yet, because in Singapore you still need to have a salary, you still need to work.